It's okay. So my name is Esther.
Hi, good morning. My name is Celeste.
We are both second-year students at Boston University School of Law, and we are both student advocates in the Startup Law Clinic. And today we're going to be talking about equitable equity distribution in your startup and how it can support your goals. So this is a quick agenda for today, and we're going to start out by setting a good foundation for our discussion later on about equitable equity distribution, which is more the heart of our presentation. So in order to have that conversation, we're going to start out by laying a foundation on exactly what equity is and what the process of distributing it looks like. And then we're going to transition into talking about how to analyze contributions and value in your startup. And then we are going to go through some fun applications to put you all to the test, just kidding, with the tools that we're teaching you today. So before we get into any specifics, a quick disclaimer that this is going to be a very general overview of equity distribution and any common issues that can come up. But as you will soon see, equity distribution is very case and client specific. So it is important that you speak to a lawyer about it. And if you are a current MIT student or a BU student, you can come and speak to us at the Startup Law Clinic, and we'll be happy to help you.
And then also just quickly, today's presentation, the slides will be available later on. You'll see we have some fun hyperlinks scattered throughout for your reference. So you can see those in the future and then this recording as well, since today's presentation will be recorded too.
Yes, exactly. We also have some fun and very helpful legal resources on our website that you can peruse. So as I mentioned, we're going to start out by discussing the necessary legal and business background, and that'll help us to later get into the heart of our presentation, which will be discussing how an unequitable equity distribution can lead to discriminatory business practices, and those discriminatory practices have both legal and business consequences. So you'll notice throughout our presentation that it's going to be kind of a blend of business and legal advice, and really it's important to understand that these are all, as I said, very case and client specific. So take everything in and really consider how it applies to your specific startup. So we're going to start out by giving a brief introduction to equity, the what and the how. So we have broken this down into 5 main points. The first being that you should know what equity is and how it works. So in short, equity is an ownership interest in a company, and
it looks like we lost Esther for a little bit there, but I'll hop on in. So as she was saying, so equity distribution is a way you can attribute partial ownership to your employees or founders. It's a business decision. Deciding who gets what equity, of course, is a determination you'll make with your team and considering lots of different business factors. And Esther, if you've rejoined, I'll let you hop back in.
Yes, thank you so much, Celeste. Sorry about that. Hopefully it won't happen too many times, but exactly as Celeste mentioned, thank you. That is exactly what equity is. And it's typical to distribute equity to people like your founders, advisors, your key employees, and your investors. You typically issue equity to all of your founders during the formation process, and you will most likely become a corporation or an LLC as a startup. Those are the 2 most common types that we help startups become as a clinic. And I will also point out that today we are only talking about for-profit companies. That might not be the company that is best for you, and we're happy to discuss that further with you on an individual basis. But you can also issue equity later on through a similar process to newer members that you bring on further down the line. And then finally, as outlined by Celeste and in number 2 and 3 here, distributing equity is an important business decision, but it is informed by a legal process, and that's where the lawyers, come in. So granting equity is primarily a business decision. It's really not an easy one because it involves a very careful evaluation of each person's role. In other words, what is each person bringing to the table? it's a very qualitative and subjective decision-making process, and it should be, because each of your businesses are unique and each person or role is unique. However, because it is subjective, that leaves the door open to potential human error and potential discrimination. So that's why we come in and we're giving you this presentation today. However, granting equity has really important benefits for your business. We have 6 bullets here, but they really break down into 2 buckets. The first being that granting equity helps attract and retain employees, especially when, as a young startup, you don't have that much cash to distribute as a benefit. And then second, it aligns the interest of the company with that of the founders and employees, because when the company succeeds or its stock or membership interests go up, so do the employees. So as I mentioned earlier, you will most likely either become a corporation or an LLC when you form your entity. And we're going to start out by discussing the equity distribution process as a corporation. So for corporations, there are 2 types of stock, common and preferred. The main differences being that preferred stock does not come with voting rights. So the holder of that stock won't be able to vote on the board of directors or any other corporate matter that goes to a shareholder vote. Second, preferred shareholders get paid dividends before common shareholders. And finally, common shareholders are paid out less in the event of dissolution or bankruptcy. I will note, though, that it is typical to not have both types of stock when you first form your corporation. In fact, as a clinic, we typically only use the common stock when we first form a corporation. So there are also 2 types of equity compensation, restricted stock and stock options, and I'll go into the key differences between the 2 on the next slide. Further, becoming a shareholder gives the founder or an employee a share of profits and losses in a broad sense, meaning that the founder's share value is impacted by the success of the company. So they share in the profits and losses by becoming a shareholder. And moreover, as a corporation, it also results in double taxation because the corporation is taxed at the corporate tax rate, and then the shareholders are again taxed on their dividends at the personal tax rate. And then finally, we have a list of the forms that we as the clinic would help you execute in order to distribute equity in your corporation. As mentioned, now I get to tell you about the difference between restricted stock and stock options. So restricted stock are shares that come with conditions that restrict the shareholder before they can sell or transfer the stock. Examples of those conditions include a right of first refusal, which gives the corporation and or its shareholders the option to repurchase the shares before they are sold to anyone else. Another common condition is the company veto right, which means that the company can veto the person or entity that the shareholder is planning on selling to. Additionally, restricted stock does grant the owner voting rights. And finally, it is very common to have what is called a vesting schedule for individuals in your corporation and your LLC actually, because for vesting, it's something that you typically give to founders or employees that are giving their services in exchange for working at the company or for the stock, because you're incentivizing them to stay longer by giving this to them and in the hopes that the stock price will increase. And so that means that because they're earning their share of stock over a certain period of time, their unvested shares will become subject to forfeiture if they don't reach their vesting date. So, for example, a founder or employee decides to leave to explore another opportunity. Any shares that are left unvested will return to the company. And then second, stock options. Stock options mean that the shareholder has the right to buy the shares at the current fair market value price at a future date. So that person would benefit because hopefully the current market price is lower than the future price, and they get to benefit from the difference between the 2. However, stock options, unlike restricted stock, do not give the owner of the option voting rights or any other rights associated with the ownership until that option is exercised later on. There are also 2 types of stock options, incentive stock options and non-qualified stock options. There are a few differences between the 2, but for our purposes today, really you should just know that ISOs have tax breaks on any profit. So that's the main benefit of them. So the other type of entity that you could become as a for-profit entity is an LLC. So LLCs, unlike corporations, which have stocks, LLCs have membership interests that are allocated or expressed through percentage or units or any word that you might choose, but we typically do it through percentage, units, or both. And the membership interest is given in exchange for a capital contribution. This can be cash or non-cash. Examples of non-cash contributions include things like property. So if you happen to have a warehouse, maybe, or a couple computers, that would count as real property. It could also be intellectual property, also very valuable. And finally, it could also be services. And unlike corporations, members that hold interests or units do not have double taxation because LLCs are afforded what is called pass-through taxation, where the profits pass through to the interest holder. And instead, members are allocated a percentage of profits and losses for tax purposes, which is distinguishable from distribution. And also, the actual distribution of the revenue will depend on the terms set forth in your LLC operating agreement, which we as a clinic would help you to write, or your lawyer would help you to write. And so, for example, the operating agreement might dictate that any profits go back to the company before they go to any members, so the members might not see any money themselves. And then again, we have a list of the forms that we would help you execute for an LLC equity distribution. So now that I've gotten to legal babble at you, we get to the heart and more exciting part of our presentation, which is how an equitable distribution of equity will support your goals. So from a legal perspective, equitable equity distribution keeps you protected from legal action and disputes. So as a startup, you probably don't have the resources to fend off a discrimination claim, which can get pretty costly. So it's really important to avoid any semblance of discrimination at all costs. And then also from a business perspective, equitable equity distribution helps you to attract and retain talent, mostly because really everybody wants to work at a fair and welcoming work environment. So you might look at this slide and think, why are all these employment laws on here? I didn't know that these applied to me. That is true to a certain extent. However, equity does qualify as a form of pay under many employment discrimination statutes. And for example, the Equal Pay Act, which most companies fall under, has equity as a form of pay explicitly. So although equity is not a replacement for salary, it can be a tool for discrimination, and that's why these federal laws have been enacted to prevent that from happening. So even though as a startup, you might not necessarily have 15 or 20 employees right now, meaning that you fall under Title VII or the ADEA, you want to make sure that you have proper procedures in place that can grow with you, because hopefully you will have 15 to 20 employees one day and these laws will apply to you. And then finally, as a quick tangent, all companies must still comply with other employment laws, including minimum wage, payroll tax, and more. And you can use this very helpful past clinic presentation on employment law compliance for more information on that. And just to hone in on why this is really important with a real world example, recently Pinterest, which hopefully some of you have heard of, was accused of gender discrimination under the Equal Pay Act because of retaliation, wrongful termination, as a result of their COO being hired with a less favorable equity compensation package than her male peers. So what happened was that the COO was given what is called backloaded equity when she signed on. And that means that as part of her vesting schedule, 10% of her shares vested the first year, and then 20, then 30, et cetera. So in a sense, she was being incentivized to stay longer because the longer she stayed, a larger chunk of her shares was vesting every year. She thought that this was standard practice for all the other executives at her level, but it turned out that none of her male peers had this type of equity, so they were not being incentivized to stay around in the same way. So this really is an example of an ironic dynamic where Pinterest, despite marketing itself mostly to women, has leadership where it is allegedly riddled with gender bias. Equitable equity distribution can also help you.
All right, I'll jump in for Esther again quickly. Oh, Esther, are you back?
Am I back?
Yes, you are. All right.
I'm
Perfect.
back. It's okay. This is my last slide before I pass it off to Celeste. So we can do it. Okay. So Carta, which is a company that develops software to help companies with equity management and valuation, analyzed its users and found these pretty jarring statistics. Like, for example, although Black and Latinx workers make up around 30% of the US labor force, only 16% of employees that they analyzed hold equity. So your startup can be a part of the solution to systemic discrimination against people of color, women, and other minorities in businesses. And we will also see on the next slide with Celeste that these trends are unfortunately reflected on a larger scale within the startup landscape in general. So by becoming a part of the solution on an equity distribution level, you can also be a part of the solution on the larger scale.
All right, perfect. Well, thank you so much, Esther. You've really done the hard work kind of laying down the foundation for the rest of our conversation today. But taking a quick step back and just discussing the startup landscape as a whole, the vast majority of startup executives are white, about 77% in the United States. And people of color are underrepresented in executive positions and in the startup community as a whole. One really interesting study we read in preparation for this presentation outlined how higher education helps some groups break into the startup scene, but didn't have the same impact for Black and Latinx students. So folks who get those MBAs and JDs and are highly qualified, highly educated, still being unable to break into the startup executive positions and landscape as a whole. This diversity gap harms the innovation and success of startups. There's lots of data, scientific, quantitative, qualitative evidence demonstrating how this gap stifles innovation, prevents the successful flourishing of different startups, and how having a diverse executive and startup team helps your company to flourish. This slide has, I think, some jarring headlines that really capture the current startup landscape and the diversity gap. Overall, folks of color have been locked out of a lot of funding opportunities. A recent study gave different venture capitalist firms pitch decks. So the firms didn't meet the teams when they received the deck, but they were told the makeup of the team, if they were men and women, the demographics of the team, what they looked like. And this study found that the firms actually spent most time on the all-male pitch decks, which resulted into spending more time with them during the actual pitch and more offers and funding. And this bias, early funding, especially in this, beginning stages of your startup, has the potential to really make or break things and can be very detrimental. There's also a lot of advice or, feedback or, guidance we give in the startup community that can sound like asking friends and family for, your initial round of funding, thinking of people and connections. And while this guidance can be helpful for folks who might not have these connections or come from different socioeconomic statuses, the advice is not helpful and actually can help propel these existing inequalities. This quote is from a Boston Globe article just published this past January that was examining 2021's funding landscape in Massachusetts. So last year, venture capitalists funneled a record $34.8 billion to startups in Massachusetts, but only a tiny fraction, probably as tiny as they come, 0.4%, went to startups with Black founders, according to a Globe analysis of Crunchbase data published in January. This figure has barely changed since 2016, when nearly 0.3% of venture capital went to companies in the state with a Black founder. And it's lower than the nationwide average in 2021, which was over 1%. So Massachusetts, we're a startup hub, we're a hub for innovation, we're a great home for entrepreneurs, and we're doing worse than the rest of the country in this space. So I think this quote and this analysis, I really encourage everyone to read the Globe article linked here, gives a really accurate description of what Black founders are up against and how disproportionately funding is being granted. We know that diverse startups are more innovative. They have a better understanding of their market, their customer base. They are better qualified to identify different risks. And then businesses that have diverse workforces and managements, they outperform their peers looking at almost every metric. This conversation is really about equity and being an equal employer, but there's also a strong business case here as well. And there's a legal case, like Esther talked about earlier in our presentation, at the federal level, of course, but we're seeing some states as well. Like, for example, California is requiring companies to have board representation from underrepresented communities.
Right, exactly. And then also, it's worth noting that I think NASDAQ recently, the past year or the year before, is also requiring companies to have board representation from underrepresented communities before companies go public through them. So as Celeste mentioned, definitely happening at the state level, but also on the private and national scale.
All right, so we talked a lot about this kind of elusive, secretive process. What is equity distribution? So now we're going to dig a little bit more into the process. One big component or a challenge of equity distribution is that it's so subjective. There's no exact roadmap or formula, and the subjectiveness means you can really leverage it as a tool to promote the success of your company. But when things are subjective, it also allows our biases to creep in, the structural society we live in to bear its full impact. So today's presentation will hopefully start the ball rolling in terms of thinking about how you, as founders or as part of startups, etc., how you want to navigate this process. An employee option pool is how a lot of companies set aside equity to distribute to future employees. So as new employees are hired, they can be compensated with stock from the employee option pool. So equity that's been set aside for future employees coming in. They can range from about 10 to 15% of a company's overall outstanding shares, but this number can fluctuate based on funding rounds, if founders choose to contribute additional amounts to the pool, and then of course, as you hire on more employees, the pool is diluted. So how do you decide? It's difficult, and it's a really important tool. Equity, especially in early stages of a startup, can be a great way to enhance. Maybe you can't offer that really competitive salary for that talented individual you're trying to get on your team, but you can offer equity. It helps align your employees' goals and your company's goals, like Esther hinted on. That's a great way to really get everyone on the same page, working towards the overall success. And it can just boost overall compensation. That's a great way to reward your employees for all their hard work. And determining how much to give to who can be complicated. And we're also working on a timeline like this graphic suggests. So, equity is a net sum game. You have a certain amount to work with that can make it a challenging process. And when you're thinking about distribution, maybe your distribution in the early days looks different than when folks join later on. So maybe earlier you can't offer that same competitive compensation package in form of salary. So maybe you offer a little bit more equity. Maybe folks are giving property or connections, or they're bringing talent your company really needs to the table. So in this example graphic, we have the founders getting about 10%. We have an early business advisor, 0.35%. Engineers at 1%, marketing specialists hired later on at 0.25%. So you can see how this can change a lot as your company grows and expands. And it also will really depend on what kind of company you are. So maybe you're a company that really relies on innovative marketing practices in order to get your product or service to your customers. That might mean that super talented marketing specialist you're very eager to get on your team might get a little bit more equity. Maybe you're an engineer heavy startup where you really need talented engineers who can work quickly and get your product to market, get that MVP ready to go. So there's all these different considerations that'll be really unique to you and your business. These are some things that you might want to consider when thinking about equity distribution. Probably pretty basic, but what role is someone playing? Of course, founders, usually founders are receiving significant parts of equity when they're joining from the start. They're playing key pivotal roles, getting the startup off the ground. Maybe you're looking at folks' experience, how closely they are tied to the business or product development. And how about their contributions? Are they like the awesome pitcher who successfully got you in front of different venture capitalist firms, got those deals to be sealed? Maybe they made an initial investment. Maybe they really provided the monetary funding up front to get the ball rolling. Or maybe, some key intellectual property, whether that is copyrighted material, patents, all sorts of trademarks they're coming up with. Those are all things you might want to consider when thinking, maybe I want this person to stick around a little bit longer. Of course, timing, it makes a lot of sense typically when folks join earlier. Not only might there be more equity to distribute, but maybe that is a way to boost overall compensation. And then what's the importance of them hanging around? Do they have a unique skill that'll be really hard to replace? What would the impact of them leaving be? Equity is one of many different tools you can use to compensate employees. You by no means have to award equity to everyone. But for folks who you really are joining on the early days, that you need to offer it in terms of making it a competitive offer, in terms of folks you want to stay with your company long-term, employees whose interests you want to align with the interests of your company. These are all different things you should be thinking about. So we've talked a lot about how just subjective and unique equity distribution and the process is. And being equitable during it requires being conscious about it, thinking about it, being transparent. That's one of the best ways you can be equitable, sharing your process with your team, with your employees, being ready to talk about it as a group, and really maybe not make in the moment decisions about distribution, and be ready to do the thinking ahead of time. Consider how structural racism and sexism can impact distribution. Are there certain roles that certain folks tend to play that you're typically rewarding for more equity? Investigate why. Think about why you're making these decisions and how they might be propelling existing gaps. Earlier in our presentation, Esther talked about vesting and how not all equity may be actionable right away. Maybe it happens over time, or there's a cliff. And sometimes life happens. Maybe your employees have to leave for family leave, or they're a caregiver, or maybe they have to relocate. They have a spouse in the military and they have to relocate across the country, and that's going to take some time. Does your vesting schedule allow for that? Will they be able to return and not have their vesting schedule be changed or lose out on equity? These are things you can think about when establishing your initial equity distribution. You also can build in measures to be flexible as these situations arise. And I think, the idea of today is just to think about all these different situations and how we can promote an equitable experience for employees who might have different uncontrollable things happening, but you still want to keep on your team.
Exactly. And I think when Celeste talks about this, it reminds me of the difference between equity and equality, more generally speaking. Some of us may have seen the viral image that went around a little while back of 3 people looking over a fence, and they're all different heights. So they need different sized boxes to be able to see over the fence. If you give them all the same box, equality, it's harder for them to see. The analogy isn't perfect because you don't want to just give family leave or caregiving leave to certain employees and not to others. But I think the point is that you want to consider all the types of individuals that are hopefully going to be working with you and their different needs that they'll need to be fulfilled for them to succeed at your company.
Absolutely. Thanks, Esther. All right. So one common way, if you've had a job before, you're probably used to how negotiation works. Maybe this slide kind of puts a pit in your stomach already, like it does for me, but this is quite a common practice that employers and employees rely on to land on a salary that is amicable to both parties. But relying on negotiation, or for employees to push back or produce the first number for their desired salary, can contribute to unequitable practices. There's a very well-known, well-studied and documented gender and racial bias with salary negotiations. So while men negotiate, they're actually seeing more favorably when they do so, and they are more successful when engaging in negotiation. While women and people of color, when they do negotiate, they're actually seen more negatively and are overall less successful through the process. A lot of times negotiation also relies on someone's previous compensation. So that's the number they're basing off their negotiation, the evidence they're using to demonstrate why X salary is the best fit for them at this time. But this can propel existing pay gaps. So if, because of the structural setup of our society, people of color and women are already not making quite as competitive salaries as their male peers, relying on past compensation for this process can, exacerbate that existing gap. It's illegal in many states, including Massachusetts, for employers to request the previous compensation from their potential employees. But of course, employees can offer it. So this is something to keep your eye on, thinking about how negotiation might impact your employee structure, how you bring on new employees, and your salary compensation process. All right, so I hope this is a popular example, but I'm sure we have some Shark Tank fans in this entrepreneurial space. But in case you don't know, Shark Tank is a popular kind of startup TV show. Different entrepreneurs and inventors get to pitch their company or idea to a panel of sharks or investors, and they have the opportunity, they want to negotiate the deals. There's lots of back and forth. Very interesting to see, to watch. I highly recommend it. So very interestingly, on Shark Tank, men and women receive deals at the same rate, about 59 and 63% respectively. But men are more likely to negotiate their offer. So more likely than women to negotiate. And when they do, they get better deals. But when women who are already less likely to negotiate try to negotiate, they actually get worse deals. So they pay a higher social cost when they go out on that limb and negotiate. And obviously, Shark Tank's a TV show. This is an empirical scientific study, but I thought it was a cool way to demonstrate how this process plays out in real life. And overall, equal work deserves equal pay. And there's kind of no ifs, ands, or buts about it. There's legal consequences. We talked about the Equal Pay Act. Relying on negotiation can contribute to unequal pay and propel on existing inequalities. Plus, there's nothing worse than an employee than learning that your coworker who does the exact same job, the exact same experience is being paid or receiving more equity than you. That can lead to employee turnover and dissatisfaction. So negotiation, though, again, it's very common. It's, accepted in most industries. It is something that you can examine both in your salary process, but also in how you distribute equity. The key solutions we've identified so far are transparency. You can share openly with your employees what equity folks are receiving. That way they can advocate for themselves to receive a more fair compensation package. It can hold your company to a standard, knowing that your employees will see the packages of others. So it will help prompt you to think about how you're distributing equity and what the impact might be. You also could consider standardizing rates. So maybe for a certain role and based on experience, everyone gets X amount of equity. That way it can be a really fair and transparent process. You also could consider sharing with employees up front. So for example, if the equity distributed to one employee is changed via negotiations, maybe they have a better offer somewhere else and you're trying to get them more equity to keep them on board, you could consider then changing that equity for employees across the board. And practices like this will not only help gain trust and camaraderie amongst your employees and help create a team-like atmosphere, but it will also help everyone be on the same page, everyone again working towards more equitable compensation. All right.
With that, we get to turn the spotlight onto you all now. Just kidding, but we would love your participation in going through a few situations that we've set up in an effort to help you apply the tools that we've taught you today. Because as we mentioned, all of these things are very case and situation specific. So the hope and the dream is that you will take these tools and figure out how to apply them to specific situations. So this is our first scenario. We have 3 founders, one who does coding, one who raises money, and one who does social media and design. So what questions might you have about each person's role, the venture in general? We can also rely on Celeste's very handy table on the next slide to look at some factors that you might consider. So if you have anything, you can put it in the chat or just jump in. Raise your hand.
I'll toggle back and forth.
At each other.
Toggle back and forth a little bit to refresh memory.
Sounds good.
Well, I hope we'll have some takers, but I can maybe get us started, Esther.
Yeah, let's do it, Celeste.
Maybe these are too basic of questions, but I'm just curious what this company does. Is coding super important? Do we social media? Maybe we're a social media company. I really want to know what the product or service is first to get us started.
I completely agree. Anyone else have any thoughts? We're sick of these situations by now, so would love a fresh take, but maybe people want to hop in on the next one.
I would ask like how much experience each of these people have, and
Yeah.
like what their unique contribution, like what can they bring to the company, and whether like there's like alternatives, like if it's like this is one really special coder, or if like this is one marketing person that we can't really find or had difficulty searching for.
Yeah, definitely. Thank you, Alan. Agreed. Maybe also like when each of them plans on leaving, if they have any plans to leave in the shorter term, those are all things that we would consider. So great. I think we can move on to the next slightly more exciting one. So now we have two founders. They're both 23 years old. They just graduated from MIT. Congratulations. And they are now looking to add a new team member who is 45 years old and has 20 years of venture capital experience. So any questions that you might have, totally okay to repeat from the last one because there are some similar questions to be asked.
I think one of the questions I would ask is that what kind of role do they hold for this company? Since it didn't get indicated.
Definitely. So are you talking about the venture capital new member or maybe the two founders?
Right. So basically what kind of business are they doing, and or is it the same same business as the last question, or the last scenario?
No, it could really be any business, but I think that maybe what you're also hitting at is like, do they even need someone who is going to be helping them raise money at this stage? Like they could be very early stages or really might not need that much investment. We don't know. Those are definitely good questions to ask. Yeah. I think another thing that we were thinking about is that either the 23-year-olds might not understand the value that someone with this much venture capital experience is bringing to the table. And then on the flip side, maybe they are opening the door to get taken advantage of because this person has a lot of experience and might ask for a larger chunk of the pie than they might deserve. So now we have a little plot twist, same as the previous example, but now the new team member would like to work part-time, so 20 hours a week to take care of their kids. Does this change anything from the last slide that you were thinking about? What other questions might you have?
I really think like my knee-jerk reaction here is, okay, less time, less equity, but I'm after today's presentation, I'm a little more sophisticated.
Yes. I think a big question I have, at least for the team, is like what is fair in this case? Because I think like we need to make some sort of deal that's like fair to other employees that are basically going all in on this venture, whereas this new team member is not really, it's kind of like half and half, wishy-washy. Right. Whether there should be equity at all and how much is there is something that I think we should discuss with the team so that everyone has like a mutual understanding of how we're being.
Exactly.
Definitely. That gets to Celeste's point about transparency in general. Although I guess I will point out that we didn't say explicitly that the other team members were working more hours a week. They might be putting in the same amount of time. And I guess in this scenario, we can say definitively that they're ready to bring on someone with venture capital experience to help them with the next stage. But something that we were thinking just to counter that a little bit is that maybe what this person is bringing to the table more than anything is their connections, which are very valuable. And maybe they don't need to work more than 20 hours a week to mine those connections and to get the full job done to deserve a good chunk of the pie. A slice of the pie, I guess.
To your point too, Ellen, you're exactly right. You don't have to distribute equity. I think a lot of times there's, especially early on, folks are like, oh, equity comes to everyone. But I think it's something like you were alluding to, you would really think critically about and think about, is this a person that we really need for the long term? And if it's someone that you would give equity to or not. So I think that's a great kind of start a way of thinking about it and thinking, yeah, exactly. Let's really examine what this team member is doing before we make this decision.
Exactly. Yeah. And we will point out that 20 hours a week is still a lot of hours a week. I know that when I was working a a full-time 40-hour-a-week job. I definitely didn't need all of those hours every week to get my job done. So don't tell my former employer that, but that's also something to keep in mind. Anyone else have any final points on this scenario before we open up to general questions?
All right. So Esther, I know Alan sent a question a little earlier in the chat. And Alan, I think I have a broad view answer for you. So the option price is determined when the options are issued. So the exercise price is already set by contract, and that would reflect the fair market value at the time the options are issued. And so even if the options are vested, there could be time limits for when the options could be exercised. So there might be restrictions on when you can actually exercise the options, but typically the price would reflect the fair market value at the time they were issued.
Exactly. And generally, when you are forming your corporation or your LLC, you will set a par value for your stock for a corporation, and that's usually a fraction of a penny. And that helps you as a founder to buy enough slice of the pie without going into debt.
Right. And a logical follow-up question would be, well, how do you set that exercise value at any point in time before you've gone public, to sort of address Alan's question? And I've lived this as somebody who was general counsel of a company that wasn't public and then went public. And it's arbitrary, right? You've got to be able to defend that it was a fair value number, because otherwise there's a taxable benefit. If you priced it below fair value, there's no problem really with pricing it above fair value, except that it's not as favorable a thing to get. But I think this is one of the reasons that a lot of people are doing restricted stock instead of stock options. It's hard to do this valuation. I mean, somebody won a Nobel Prize for figuring out how to value options exercisable in the future. So it's hard. Sometimes you'll have companies where there will have been transactions where people sold their stock, on an arm's length basis back to the company, and you could use that as a basis for the next round of stock options. But at the beginning, you're just guessing. And as Celeste said, you may just say, well, we're not worth anything now, so fair value is a penny, and we're just going to call it a penny.
Yes. Thanks, Jim. Austin, did you want to jump in with a question?
Yes. And thanks a lot for sharing everything. So I have two questions. The first one is, remember you mentioned, so there's equity structures. I'm just kind of curious if we're doing incorporation, and is it better just we can maybe leave 20 to 30% for future investors, and then for the rest of funders can just share the rest of the around 70 or 80% of share. And so that's the first question. And the second question, just kind of curious, because for a venture with multiple funding team member, and will be a common structure for a team, maybe for example like 5 or 6 funding team member.
Yeah, I guess the first question is to one of your slides, Celeste, the employee option pool, if you want to go back to that. If I'm right, if I got your question correctly. Oh no, it's a little different. Never mind. Yeah, are you asking like how much would you save for your founders?
Yes, and just basically a percentage in between funders and also for investor. I know there's maybe not a right and wrong answer, but just kind of curious about the general agreement.
Yeah, I think you're exactly right. There is no right or wrong answer. I think I've personally seen a range from like 30% set aside for founders to 50%. That's maybe more standard. And then for advisors, like exactly like you said, it depends on like how many you might need to take on in the future. But maybe it depends really. Celeste, did you have thoughts about that? You were nodding.
Yeah, no, just kind of agreeing with what you're saying, Esther. And then of course, like this is where it kind of muddles. It's really a business decision and a legal decision of trying to kind of forecast your company's growth and what that might look like. But if you haven't engaged with the Startup Law Clinic yet, I think especially looking at the legal process of this allocation, that's something our teams could help you walk through. So I definitely would encourage you to set up a consultation or an intake to see if there's a way that our clinics team could advise you on this process and help you figure it out.
Exactly. And it'll also depend kind of too on how many authorized shares you have from the onset. So there's a range from like 1,000 authorized shares when you first begin to 10 million. And so you can see how a percentage that you set aside would vary very greatly depending on that.
All right, great. Thank you.
You're welcome.
All right. Sid, I think your hand was up next. Hi, nice to meet you.
Yeah, nice to meet you guys as well. Thank you for the presentation. I think you kind of touched on it just now, Esther, but I feel like there's three ways that companies disseminate their equity, and it's in three units, I suppose. It's like either dollar amounts that like a fixed, I think, for example, Facebook might do like you get $25,000 every year type thing. Or there's the percentage, which you had in the slides, which was that seems very transparent to me for both the company and the employee, where you know exactly how much, what slice of this company you're getting. And then there's the shares. So I guess I wanted to understand, does it all boil down to the same thing in some vesting schedule? Or are there advantages and disadvantages to the different ways?
I think really you're talking about different ways of doing the same thing, and you can apply the tools that we talked about. So vesting schedules, options, restricted stock in each of those scenarios. But like you mentioned, and as Celeste said, doing percentages is like an easy, transparent way to do it.
Okay.
And for equity, the sum total is always going to be 100%. So for today's presentation, it's an easier way to talk about it. But yeah, exactly. It's just different ways of thinking about the proportions given to each employee or investor. But a lot of times I do think thinking of it as a percentage, or even when you're communicating with employees, talking in percentages could be a great step towards transparency and then hopefully being more equitable too.
Thank you.
I think this is also a good point. Yeah, Sid, you brought up Facebook. I think, just keep in mind that they have several classes of stock. And also at this point, people who are getting stock aren't getting stock in order to have some sort of voting control of Facebook. It's purely compensatory. So, what we're talking about here in this presentation is kind of a mix of compensation, but also real voting power in the company. So this is like early stage typically. What's happening at Facebook or like Google or Amazon, when any new employee comes on, if they're getting what's called equity, it's usually typically they might say you're going to get like 25K worth of equity, but it's not like voting power. It's just it may not even be real stock. It might be some sort of kind of equivalent where it's pegged to the value of the publicly traded stock. So there's a lot of complications and variables going into like a massive company like Facebook giving out compensation that's equity. But what we're talking about is typically a situation where it's stock that is also being anticipated to provide real voting power, or it's early stages of options being used as compensation, but definitely not in a level of complexity that you're seeing at like Facebook or something like that.
This is also, I think, a good opportunity to introduce Sam and then Jim, who jumped in hopefully earlier, and I think Daryl's also here. There are 3 supervising attorneys at the clinic.
Awesome. Thank you all so much.
Thanks for your question, Sid. Alan, did you have another?
Yeah, I had 2 quick questions. So one's kind of like building off of Jim's response earlier. So Jim said these days more companies are moving towards restricted stock instead of stock options. But I'm curious, like when an employee leaves a company and sells their restricted stock back to the company, how's the price there determined? Especially if they stayed a long time and the fair value could have increased or changed.
Yeah, I think
Jim was
Jim tackle this one. I think it can vary a lot, right, Jim, based on what they estimate their fair value at the time in the market.
Right.
saying
And
something.
Celeste is actually working with
There we go.
Celeste is actually working with me on a client that has this situation right now. And you know, it's there are two answers. The unvested stock you're able to buy back for the same nominal value that it was issued for, because you should have an agreement that says that any stock that hasn't vested yet can be bought back for the same nominal price they paid for it. The question is, how do you make a proposal to buy back the vested piece? And the answer is it's arm's length at that point, and it's whatever the two parties can agree on. Unless you have an agreement ahead of time that you have the right to buy it back and some sort of formula or method for determining the price, then that person can walk away with their vested stock and sit out there as one of your shareholders forever. So, you know, we often encourage clients to think about what might incentivize the client, what might incentivize the former shareholder to give up their shares, particularly if it's a big enough piece that having it sit out there is going to impair the company's ability to get somebody else on board to replace them. And, you know, it's a dance. At that point, you know, they've left the company. They're no longer your best friend. You know, they're somebody you've got a business relationship with.
All right, thank you, Jim. And I think a second question I had was, how do you kind of deal with employees that ask for like bonuses or like compensation later on in terms of equity? Like if a certain employee settles like a really big deal with a customer, is it common to have equity used as bonuses, or how is equity like further issued to employees that already are on a vesting schedule?
Yeah, so I think this will probably vary a little bit by industry and, you know, company type, but I can talk a little bit about it broadly. Bonuses, probably the majority of the time are given out as pure monetary compensation. That is an option I think most employers or companies will use. If you have stock and equity still available in the employee option pool, you could consider giving equity as part of that compensation or reward as well. But you'd have to consider all the other factors of, you know, equity is a zero-sum game. How much more do you have to distribute to future employees? Will it create a disruption later down the line? Does that give your employee more voting power? So I think there's a lot of the same considerations at that timeline for that decision as there are earlier in your company. So I think typically you'll see large financial bonuses in the form of like a one-time cash payment.
Exactly. And the process for distributing equity later on is very similar to the process that you will go through initially.
Thank you.
You're welcome.
Well, we're just about out of time, but it was great speaking to you all today. I hope this presentation was engaging and, you know, it kind of gave probably more questions left than answered, but hopefully starts thinking about your venture in this by this perspective. And we wish you all the best in the formation of your different inventions and companies and LLCs. And we definitely encourage you to reach out to the Startup Clinic to speak to our teams, whether a consultation or an intake. And we are happy to help with whatever legal needs we're equipped to. So thank you again.